Hi everyone, thank you for coming today, and thank you, Professor May, for those kind words. This has truly been a team effort. It's my great pleasure to host Howard Marks today. Howard is the co-chairman and co-founder of Oaktree Capital Management, which is the largest distressed debt investor in the world with about $200 billion in assets under management. He's also a thought leader in risk management, market cycles, and investor psychology. Howard, it's a pleasure to have you here today, and I'm going to leave it to Ghaith and you to kick things off. Thank you.
It's truly an honor to have you here. Okay, I wanted to start by taking you way back. You were at the University of Chicago in the late 60s at a time when it was pioneering the field of finance and laying the foundations for modern investment theory through ideas, of course, like the efficient market hypothesis. Looking back, how did that experience shape the way you view investing? And more importantly, in what ways did you find yourself thinking differently from some of those core teachings?
Well, I was very fortunate. When I got out of high school, I went to Wharton, undergraduate, got a degree in finance. At that time, I had no idea that I would go to graduate school. It wasn't the norm in any way. But by the time it was time to leave college, number one, I think an MBA had become more the norm. And number two, there was a war going on that I wasn't eager to participate in. And if you came out of school, you had a good chance of going over to Vietnam. And then a reasonable chance of not coming back. So that wasn't that attractive. At the time, if you went, as long as you stayed in school, you were exempt from the draft. So, you know, some people became lifetime students. But anyway, so I turned to getting an MBA. I applied to Harvard and Stanford, which turned me down. I didn't want to go to Wharton again, having gone undergraduate. So Chicago was the best choice. And I did go there, and as you say, Ghaith, you know, what we call the Chicago School of Finance Theory had really just been developed there, mostly between 62 and 64, and I got there in 67. So I was a member of one of the first classes to be taught that stuff. And if you've read Malcolm Gladwell's book, Outliers, it's all about what he calls demographic luck. Right time, right place. And what it really means is being at the head of the line. And so fortunately, I was close to the head of the line. And I learned a lot of important things. As you say, you mentioned the efficient market hypothesis. I think that's the most important thing I learned there. Mm-hmm. But also the idea of risk-adjusted returns and so forth.
But you think of the efficient market hypothesis different to most.
Well,
could you expand on
that? I think I do.
Mm-hmm.
And so let me just go on a bit. Okay. So I took it, Wharton, when I went there, was entirely practical and qualitative. You know, I mean, it was really, in reflection, very simplistic. Like, you know, this is a picture of the stock exchange. This is a stock certificate. If you want to buy one of these, you go here. That kind of stuff. Chicago was completely theoretical and quantitative. So it was, the juxtaposition of the two was very helpful. And but I did take one of the few pragmatic courses there, which was a course in investments from a guy named Jim Laurie. And for me, that was a highlight of my education. And he actually, not only did he teach non-theory, but he even had people in from the outside world to talk about their real world experiences. And the other professors were snobbish, and they derided his class. They called it Laurie Stories, but I got a lot out of it. The final in that class was, how do you reconcile what you learned here at Chicago about the theory with the real world? That was the exam. And I passed. But that question stayed with me and was very influential. And I even wrote a memo in around, I think it was around 01 or 02, or it could have been a little earlier, called What's It All About Alpha? With asking the same question. How do you reconcile the theory and the practice? Now, if you're lucky and you go to a university like this one, they'll teach you how things are supposed to be. Then you get out in the real world and you find out how they really are. And there's a difference. Now, have you all heard of Yogi Berra? Anybody here heard of Yogi Berra? No? No? No. Yogi Berra was one of the greatest baseball players in the 50s. He was the catcher for the Yankees, and they probably won the World Series 7 times in the 50s or something crazy like that, and he was a great player. And he was a great player, but he was more famous for saying crazy things that sound a little nutty until you kind of think about them. He said things like, nobody goes to that restaurant anymore because it's too crowded. Or if you come to a fork in the road, take it. By the way, he also said, I never said half the things I said. But one of the great things he said was, in theory, there's no difference between theory and practice, but in practice there is. And that's a very important guideline for all of you who, if you're learning theory, you have to realize that there is a difference between theory and practice. So now, Ghaith asks my view of the efficient market hypothesis. Do you all know about the efficient market hypothesis? The efficient market hypothesis basically says that because there are so many people working in the investment world, and they are all smart, numerate, computerized, objective, rational, highly motivated, they search for the mispricings. And if they find something that's too cheap, they buy it. But of course, that makes its price go up. If they find something that's overpriced, they short it. But of course, that makes the price go down. And when they're all done, everything sells for the fair price. So there are no bargains, there are no mispricings, there are no what the theory calls inefficiencies. Everything's selling at a fair price. And if everything's selling at a fair price, and you come along and you say, I'm going to become a famous investor, I'm going to find all the mispricings and buy them up before everybody else gets there. I'm going to buy all the overpricings, and I'm going to short them and make a lot of money when they fall. But there aren't any. So you can't beat the market, right? That's the efficient market hypothesis. And the strong form of the efficient market hypothesis, you can't beat the market. But that's the theory. In practice, it's not quite true. There are mistakes. And you know, in '99, Amazon was $90 a share. And in '01, it was 6. You can't tell me the market was right both times. You can't tell me that the market was right when it priced it at 90, because if it's going to be 6 2 years later, it should have been at 5, so you could make a little money. So the market is not right all the time. If you read this memo, What's It All About Alpha, you'll see my interpretation. But the market instantaneously, see what the efficient market hypothesis says is that because of the actions of all these investors, the market instantaneously incorporates all new information in the prices of assets so that they're correct. It incorporates all new information in the prices of assets, but not necessarily correctly. But everybody together takes all this new information, they incorporate it as they see fit, and they form a consensus. And that consensus becomes the price, you know? We wake up tomorrow morning, Ghaith says General Motors at 53, I think it's too high, I sell it there. I say, I think it's too low, I buy it there, and we do business at 53. But that doesn't mean 53 is right, you see. What the price is, it is the consensus of everybody's opinion, the distillation of everybody's opinion, but not necessarily correct. But the people who are doing the analysis and setting the price at 53 aren't idiots. In most of the time, it's as good as you can do. And if it's as good as you can do, then when Ghaith gets there and wants to become a famous investor, he walks in, he sees General Motors is 53. It may or may not be right, but he's not smart enough to know which ones are right and which ones are wrong, which ones are too high and which ones are too low. So rather than market prices being right in an efficient market, they are consensus such that very few people can consistently do better. That's the upshot. The result is the same thing. Very few people can beat the market, but for a different reason. Not because prices are right, but because people aren't smart enough. So when I went, I hope you have only one question.
Okay, actually, that's a good transition. Oh, you're still going? Okay, we'll go. You can talk as much as you like.
So when I was at Chicago, what the professors would say is that most investors don't do as well as the S&P because of the reason I just explained. Before fees, and then they charge fees, so that almost all funds do worse than the S&P after fees. So why don't they just buy one share of every stock in the S&P? Now, when I was there were no index funds or concept of indexation. This is as close as they came. But, Jack Bogle at Vanguard pretty much invented he did the first industrial grade index fund in '74. And today, and by the way, they caught on very slowly, because for an index fund to catch on, people like Ghaith had to say, okay, I give up on beating the market. I accept that I'm not smart enough. And people would say, well, it's un-American to give up. You got to try. Just try a little. You can do it. So it caught on slowly, but it did catch on, and now I'm told the majority of mutual fund equity capital is managed by indexation or passively, because people couldn't find those mispricings consistently.
But you could, and so I wanted to go to my next question, which is that I emphasized the independence part of my first question. I said, more importantly, in what ways did you choose to think differently? Because as I understand it, being a contrarian investor, it's a term you like to use a lot, has defined your career. Why is it so important in this industry to be a contrarian? And more importantly, what does it take to maintain conviction when so many people disagree with you?
Well, if you think the same as everybody else, everybody has basically the same inputs, right? In fact, if you think about the SEC, they think it's their job to make sure everybody has the same inputs. They passed a rule about 30 years ago called Reg FD. FD stands for fair dealings, which basically said everybody has to have the same information every time, and companies have to give people full information every quarter, and they have to give everybody the same information at the same time. When I was a kid, your age, and I was a security analyst, I would follow a company. Each company has somebody called the analyst contact. You would go into the analyst contact office. And if you worked for Citibank, as I did, a big place, an important investor, they would leave the budget for the next year on the desk and go to the bathroom. And I got very good at reading upside down. But literally, companies would give better information to the people that they wanted to be tight with. And of course, that's illegal now. Everybody has basically the same information on public companies. So if you have the same inputs and you think the same as everybody else, then you'll behave the same as everybody else, right? Reach the same conclusions. And if you behave the same as everybody else, then you'll have the same performance as everybody else, right? Yes. So that's not a very good formula for distinguishing yourself. And if investors get paid for beating other investors, that's not the way to do it. So I don't call myself a contrarian, but I talk about something called second level thinking. And I wrote a book back in 2010 called The Most Important Thing. And it has 21 chapters, and each chapter says the most important thing is, and then it's a different thing. Because in investing, there is no one important thing. There are many things that are essential. But Columbia Business School published the book, and they said to me, could you give me a sample chapter? So I sat down at the computer and I typed out the first chapter, and I typed out something I had never even really thought about before. And it says the most important thing is second level thinking. If you think the same as everybody else, you'll come to the same conclusions, you'll behave the same, you'll have the same performance, no distinction. So to do better, you have to think differently. That's all. You have to think differently. So when my son went off to college and he wanted to be an investor, and he would come home and he would say, "Dad, I hear Ford's coming out with a great new Mustang, we should buy the stock." So my question for him was always the same question, for rhetorical reasons. Who doesn't know that? And that's the efficient market hypothesis. If everybody knows that Ford is coming out with a great new Mustang, then the fact that it's coming out with a great new Mustang is already likely in the price of the stock. It's not like you can buy it and get that as a bonus, because everybody already knows it and they've already incorporated in the price. So you have to know something they don't know. Now, it's hard to get data they don't have because everybody's supposed to have the same data, which means you have to do a better job. You have to think differently and more nuanced and deeper and more correctly. But there's a catch. You get the catch? You know the catch? Remember what I said before. Most people aren't smart enough to be able to discern which are the inefficiencies in the market. So it's not sufficient to think differently from others. What if you think differently and worse? Then you're really in trouble. You have to think differently and better. But the real meaning, if you want to pass my exam on the efficient market hypothesis, what is the upshot? What is the importance of the bottom line on the efficient market hypothesis? Very simple. The other people aren't idiots. And if you go into life thinking that everybody else is an idiot, you're going to get into big trouble. You're not the only smart person in the world. And because the other people that you're competing against in the investing business are smart, it's hard to outthink them. And this consensus that forms, which results in the price of a stock, reflects the best of their thinking. So if they think this way and they produce a stock price which is X, 53 in the case of General Motors, how can you reach a different conclusion? And if you do reach a different conclusion, how often is your conclusion likely to be more right than theirs? You see, it's very complex. None of this stuff is subject to easy thinking. You know, when I was finishing that book, The Most Important Thing, I had lunch with Charlie Munger, whose office was in the building next to mine in LA. And we talked about the book, and when I got up to go, he said to me, "None of this is meant to be easy, and anybody who thinks it's easy is stupid." And Charlie was very direct. But if you think about it, you're in there, you're in the investment business, you're competing against a lot of other people who went to good universities, got a good education, started with a good IQ, learned some good stuff, work very hard. How can you conclude that you know better than them? And yet, if you don't know better than them, you're not going to succeed. So that's the catch. And so you have to think different and better. So if Andrew says, "Dad, you should buy Ford because they're coming out with the new Mustang," my answer is that the first level thinker says that. The second level thinker says, everybody knows they're coming out with the new Mustang. It's supposed to be great. I don't think it's going to be as great as they think it is, so you should sell the stock. That's the second level thinker. Higher, more nuanced, a little deeper, different, maybe contrary outcome. But how often can you do it better? That's the question. And anybody who thinks that they can, you know, there's 3,000 stocks on the New York Stock Exchange or something, or 3,000 public companies, I guess. Who thinks that they can go down the list and say overpriced, underpriced, overpriced, underpriced, and figure out each one? No, you have to study a few. You have to attain a knowledge advantage. You have to know something the other people don't know, gain insights they don't have. Then you have a chance of being able to think different and better. What was the second part of your question?
I think you hit every single point there.
Okay.
So you mentioned in that answer your time at Citicorp as an equity researcher.
Yeah.
I was watching an interview you did with Goldman Sachs a few years back where you reflected on this transition from being an equity researcher, where you watched people lose money daily on the so-called Nifty 50 stocks, which were meant to be the 50 best stocks in the US at the time, and transitioning in 1978 to running your own high-yield bond fund, where, to quote you, you are now investing in the worst public companies in America, according to the ratings, but making money steadily and safely. And that this led you to a profound conclusion. It's not what you buy, it's what you pay. And success in investing doesn't come from buying good things, but from buying things well. This is a very counterintuitive idea, I'm sure.
You can write the book.
Yeah. I mean, I read it, so. Yeah, so could you unpack what that lesson means? Because that's very counterintuitive. I'm sure many people in this room, they come to me and they say, company A, what a great company, you ought to buy this company. Why is that a
Well, and I wrote in one of my memos someplace, or one of my books, that I used to live in LA, and in LA you have a lot of drive time, and when you're driving you have the radio on, so you listen to radio a lot. Not in New York, you never really listen to radio. So there was this guy who come on the radio in the morning, and he would say, investor, stockbroker. They don't use that term anymore, but you know what I mean. And he would say, well, it's simple. If you go in a store and you buy a product, you like the product, buy the company, buy the stock. It has nothing to do with it. Buying the stock has nothing to do with liking the product. It has to do with the stock being undervalued. Why would you buy a stock that's fully valued or overvalued? So this is misleading to think that buying good companies is the way to make money in the stock market. Buy bargains. Buy junky companies if they're underpriced. So now I'll go back and tell the whole story. Mm-hmm. So I got out of Chicago in the summer of '69 and went to work at Citibank in the equity research department September of '69. And the bank was a devotee of what was called Nifty 50 investing. And most of the big banks were doing Nifty 50 investing. The idea of growth stocks, that is companies with new products, new technologies that would grow faster than normal companies, had really caught on in the early 60s, 62, 63, that kind of period. You know, the firm of T. Rowe Price down in Baltimore, I think they were really at the vanguard of that. And I remember seeing a brochure of theirs about growth stocks. And so everybody fell in love with, number one, IBM. You got to have IBM. Great company. They make all the computers. Number two, Xerox. Kodak, Polaroid, Merck, Lilly, Hewlett-Packard, Perkin-Elmer, Texas Instruments, Coca-Cola, Avon, AIG, and the list went on. 50. It may not even have been exactly 50. And not everybody's list was the same, but everybody had a list, and they bought the 50 stocks. So this was the first of the great bubbles that I ever saw. And it's very important that you all realize that the way I say it, experience is what you got when you didn't get what you wanted. You don't learn anything from success. Success teaches terrible lessons. And in my second book, Mastering the Market Cycle, the last chapter, maybe it's not the last, but I mean, toward the end, there's a chapter called The Cycle in Success. And basically what it says is that success carries within itself the seeds of failure, and failure carries within itself the seeds of success. Why? Because if you're successful, what does it teach you? It teaches you the following lessons. I can do it. I can do it again. I can do it as many times as I want. I can do it with as much money as I want. I can do it in other fields. And I can do it without any other people. And these are terrible lessons. And they cause you to overemphasize emphasize your skill and believe your own bullshit and think you're superior to others and think that, I don't know if I mentioned it, but one of the things people conclude is I must be really smart so I can be successful in other fields. And I know a lot of people who've made a lot of money in the market, and if they say, well, when do you think Russia's going to pull out of Ukraine? They'll tell you a month. They ask me, I say, I have no idea. It's not my field. And I hear these people, I go to these meetings, and these people give these opinions, and none of them know anything about the subject other than what they read in the paper that morning, but they think they're smart. And there was a great economist here in Boston, not a great economist, a great man, named John Kenneth Galbraith. And he was at Harvard, and he wrote a lot of books, and I was fortunate to meet him. And actually, I had a second career in the early 90s as a book reviewer for the LA Times, and I reviewed one of his books, so I got to know him. And he talked about the outstanding characteristics of the financial markets. He says one is shortness of memory. Everybody forgets all their lessons because they're sucked in by greed. And the other is what he called the specious relationship between money and intelligence. And most people, if they see somebody who has a lot of money, they figure he must be intelligent. And most people think that themselves. If I'm rich, I must be smart. And they go on these ego trips. Where were we? Okay, so anyway.
Price and value.
So the point is that the banks invested in the Nifty 50. And if you bought the Nifty 50 the day I reported to work, I think it was September the 22nd of 1969, if you held those stocks faithfully and diligently for 5 years, I think you lost 95% of your money in the best companies in America. So the point is, remember what I said about learning lessons? I learned one of the greatest lessons of my career very early, and it's better to learn your lessons early than late. And I had the advantage that I didn't have much at stake when I learned that lesson. So
then you learned that lesson, and a few decades later, you managed to apply that lesson to 2000.
He keeps trying to get me to move forward.
You applied it to 2000.
So the point is that by 1975, at the tender age of 29, I was appointed director of research at the bank. So when this thing died, I was associated with the failure of the Nifty 50. And so I was banished to the bond department, which was the equivalent of Siberia at that time. And I got sent down to the bond department. By the way, so I was 29 years old, director of research, staff of 75, $5 million budget, and I was on all the bank's senior investment committees. Now I get sent down to the bond department, no staff, no budget, no committees, and I was ecstatic because all I had to do was study a few companies in a market where other people were not active and find some special deals, which I was able to do. The boss asked me to start a convertible bond fund, which was a real backwater nobody looked at. That's where how you can overcome the efficient market hypothesis is by looking at things nobody else is studying. So that worked very well. And that was my big break. Mm-hmm. And then that was May of 78. And then in August of 78, I got a call on the phone from the head of the bond department who said, there's some guy in California named Milken or something, and he deals in something called high yield bonds. You think you can figure out what that means? Because a client had asked for a high yield bond portfolio. So that was my lucky break. And by the way, notice I didn't have anything to do with it. I didn't put myself in position. I didn't apply for the job. I didn't make a decision to do that. I just was offered an opportunity. So this is life. I'm a big believer in luck. And that was a lucky thing for me. Anyway, so as Ghaith says, now I'm investing in the worst public companies in America, and I'm making money steadily and safely. Why? Because I was doing something nobody else wanted to do. They called them junk bonds. They derided them. And when you look at something, and without reference to the merits, people say, "No, I would never do that. I wouldn't touch that with a 10-foot pole." then maybe you can get a bargain because everybody else is underrating it. So that's, you use the word contrarian, that's a way to be different from the pack and find opportunity. And that's what happened to me.
Mm-hmm. Okay. You mentioned that was your first big break, but your first big break when it came to writing memos was the memo you published in 2000 titled Bubble.com, in which you famously predicted the dot-com bubble of 2000 with remarkable accuracy and timeliness. Can you walk us through the second level thinking, since you mentioned second level thinking earlier, that guided you to see beyond the hype and recognize the underlying fragility in the financial markets at the time?
All right, I'll merely take issue with your use of the word predict.
Okay.
Because I don't make predictions.
You don't make predictions, exactly.
And I once wrote a memo entitled, "You can't predict, you can prepare." Now that's a great oxymoron, because if you can't predict the future, how do you know what future to prepare for? And the answer is you have to prepare for a future that you know you don't know. How do you prepare for a future which is mysterious and undisclosed? Anyway, October the 12th, 1990, I published the first memo. Last Sunday was the 35th anniversary of the first memo. And I wrote in those, this was pre-internet, but did you know that the internet didn't always exist? This was pre-internet. So if you would write a memo like that, what you would do is you would run off copies on a Xerox machine, fold them up, put them in something called an envelope, attach a stamp, write out an address, and put them in something called a mailbox. And they would end up on your clients' desks. And I probably had 100 clients in 1990. So I sent out 100 memos. I didn't have a plan of writing a memo every year. And in fact, I didn't write a memo every year. But I would write if I thought I had something to say. And however, I went 10 years without ever hearing a response. And this is an important lesson, because you would think that after 9.5 years you would quit. Right? What the hell am I doing this for? I'm like, not getting anything out of it. I didn't sell subscriptions, and nobody ever said, not only did nobody ever say that it was good, nobody even said I got it. And yet I kept doing it. Why? Because I enjoyed it. And I like writing, it's creative. I thought I was writing stuff that nobody else was writing, and so I got a lot out of it, and I kept doing it. Then, on the first day of 2000, I published a memo called Bubble.com. In the fall of '99, I read a book called Devil Take the Hindmost, which is a history of financial speculation by a writer named Edward Chancellor, English guy, and it was very good. And he talked about the various speculative bubbles that the markets have seen over the years. And the one I paid the most attention was something called the South Sea bubble. And it was around 1720. Now, the British government was running deficits, and they had a national debt. Sounds familiar, right? And they figured, how am I going to pay off the national debt? So they created a company called the South Sea Company, and they gave it a monopoly to trade in the South Sea. And they figured they'd make a lot of money trading in the South Sea, by which I think they meant South America, and that they'd make enough money to pay off the national debt. And everybody got so excited about this new thing that there was a bubble in the shares, and people would do things like, mortgage the house to buy stock, or quit their jobs to day trade the stock, or quit school to trade the stock and stuff like that. And I'm reading this book, and I say, that's the same exact thing that's going on now. In the tech bubble of '98, '99, there was created something called day trading. People would actually quit their jobs, open a brokerage account. You could get credit at the broker. You would put up equity, and you'd get credit, and you could trade, but the only rule was you could not carry any positions overnight. So you could buy, and then you could sell, buy, sell as much as you wanted until your equity ran out, but you couldn't carry positions overnight. And people said, oh, I'm a great day trader. Now, my interpretation of a day trader is somebody who buys a stock at 12 and sells it at 12 1/4, buys it again at 15, sells it at 15 1/2, buys it again at 19, sells it at 19 and a quarter. And he says, boy, I'm smart. Idiot. You bought a stock at 12, which is now 19 and a half, and you made 1 point. But, you know, people are not that introspective. But the point is, I'm reading that book, and I say, this is exactly what's going on now. So I wrote this memo, bubble.com, drawing analogies between the speculations of the past and what I thought I was seeing in the tech stocks. Now, I didn't predict anything. Mm-hmm. All I did is call attention to what I thought was the folly of what was going on. Mm-hmm. So the memo goes out on January the 2nd of 2000, and it had two strengths. Number one, it was correct, and number two, it was correct in a hurry. And within a couple of months, those stocks started going down. And you know, most of the internet and e-commerce stocks that went public in 98, 99 ended up worthless. But at the moment, they were extremely high. And you see, in the investment business, it's not enough to be right. You have to be right fast. Because if there's an old saying, the first of the great sayings that I ever learned was that being too far ahead of your time is indistinguishable from being wrong. You know, if you say if you say today it's a bubble and it's going to collapse, and you take all your clients and you get them out of the market, and then the market keeps going up for 5 years before it collapses, and then it crashes and falls to earth and everything is lost, by that time you're out of business. So you have it's not okay to be right eventually. You have to be right promptly. But that memo was, and after 10 years, I became an overnight success.
All right, you're a big fan of the Mark Twain quote that history doesn't repeat itself, but it often rhymes.
It's very important.
Indeed, and so 2000 rhymed with the South Sea bubble. Mm-hmm. Mm-hmm. And I have to ask you, does 2025 rhyme with 2000? Because earlier this year, you published another memo titled On Bubble Watch.
On the 25th anniversary.
Indeed, 25 years later.
Of the first one, January the 2nd of 25.
Yep.
I published one called On Bubble Watch. And because everybody nowadays, you know, here's what happens. After the tech bubble burst, then everybody starts talking about bubbles. We didn't talk about bubbles before 2000. But after 2000, it became a topic du jour. And everybody says, is it a bubble? It's a bubble. It's a bubble. Watch out. It's a bubble. It's not a bubble. You know, so everybody now wants to call everything a bubble. People want to get famous by catching the next bubble and calling it out. But I said in that memo that I didn't think it was a bubble because I think a bubble has two aspects. Number one, quantitatively, things become very expensive. And at the end of last year, the S&P 500 was selling at 23 times the next 12 months estimate of earnings, which is very high. The historic average since World War II is 16. So it was almost 50% overpriced by that standard. And there are other ways in which markets were expensive and still are. However, I think that what I said was that bubbles also have a psychological component of mania, of what Greenspan called the 96
irrational exuberance.
Exactly. Thank you. Irrational exuberance. So, and I don't detect that. I didn't detect it. Now, I'm not in the bowels of the stock market, in the trading pits, so I may be missing it, but I don't have the sense. You know, I mean, the sense of what happens when a bubble starts going. There's this sense that if you get on it, you can become rich overnight. But if you fail to get on it, you'll have to kill yourself because you missed the chance of a lifetime. FOMO takes over. And there's an interesting book called Manias, Panics, and Crashes, written by a guy named Charles Kindleberger. And the last edition of that book has a great line. He says, "There is nothing so injurious to your mental well-being as to watch a friend get rich." Now that's a sad commentary, but it's true, of course. And envy and comparing and FOMO are, I think envy is the strongest force in the world. And so, you know, and I told the story, maybe it was in bubble.com or someplace or other. I tell the story, and this was what life was like in those days. But you know, you're sitting at your desk, and you got the guy who works next to you, and you say, "What are you doing?" He says, "Oh, I just bought this stock." Oh, he says, "I heard about a stock. It's going to double, and I put in for it." And you say, "Well, what's the name?" He says, "I don't know, but I know the symbol." He says, "Well, what does it do?" He says, "I don't know, but it's going to double." So, and you say, "You're an idiot." And he puts in for it, and he comes in the next day. Well, how'd that stock do? Doubled. Then he says it again the next week. You say, "You're an idiot." How'd it do? Doubled. After about 5 of those, you say, "I'll take 100 shares." Because people can't stand to be on the sidelines watching other people make easy money. And that's human nature. And you have to understand that. You have to keep that in check, but you have to understand how psychology works. Mm-hmm. And so I don't personally think that that's out there today. Mm-hmm. Now, I think that the AI stocks may be high, and NVIDIA's 50 times earnings. By the way, the Nifty 50 were selling at 60 to 90 times earnings, the stocks I mentioned. So the Magnificent Seven have an average PE ratio in the 30s, and I think NVIDIA's 50. That doesn't seem so high to me. These are some of the greatest companies I've ever seen. Moats, incredible profitability, big market share, great products, but they're certainly high. The Mag 7 have dominated the performance of the S&P. 7 stocks have produced the majority of the gains in a 500 stock index. A substantial share of the economy is now being bet on AI. A substantial share of capital expenditures are going into AI for data centers and so forth for power. And you know, if it turns out not to be a real thing or not to have commercial application, it's gonna crater, and it could take, you know, the economy and the markets with it for a while. I have no reason to think that's the case, but nobody knows. You know, like I said, you know, these bubbles come into existence. I've seen, you know, half a dozen over my career, major and minor. It's always about a new thing, you see, because the imagination is fired by thinking about a new thing, whether it was tulips in 1620, South Sea Company in 1720, Xerox in 1969, Pets.com in 99, or NVIDIA today. It has to be a new thing, because you never see a bubble in paper stocks or in steel stocks, or, you know, it's just prosaic. It has to be in connection with something new. The great thing about something new is there's no history. So you see, history, if you know history, it serves as a tether. It keeps you grounded. You say, well, the average stock has sold it 16 times, so if the stock selling 80 times, is something wrong. But if there's no history, then there's no tether. Your imagination can float off to the stars. And or if somebody says, well, you know, if the average stock has always sold at 16 times earnings, and that's selling at 80, the rejoinder of the bubble fan is what? Anybody know? 4 words. This time it's different. This time it's different. And you know, in '87, the stock market was really rocking and rolling, and everybody was saying this time it's different. There was a minor bubble in disk drives. Disk drives were, you know, hard memory for computers, and the stock market was doing great. And I read an article, October the 11th of '87, the title was, "This Time It's Not Going to Be Any Different." And the author talked about the fact that everybody said, in a bubble, everybody says this time it's different, but normally it's not any different. Sir John Templeton, who was a great investor in the 20th century, contributed to the article, and he talked about this time it's different, cautionary, but he said, but remember, 20% of the time it really is different. And that's the thing. It's 20, because, I mean, there is progress, and a lot of it's not understood. 20% of the time things really are different, but not 100% of the time. And the interesting thing was that was October the 11th, as I told you. Anybody, you wouldn't know what October 19th of 87 was, would you? Most of you probably weren't alive. But October 19th of 87 was called Black Monday. And, you know, the worst year in the last 16 years, that's not true anymore. But prior to the pandemic, the worst year in the decade was 15. The market was down 5%. On Black Monday, the market was down 22% in a day. Imagine that. So the writer was right. This time it's not going to be any different. But anyway, I don't detect the extremes of psychological excess today. I may be wrong. We shall see.
Indeed, we shall see. All right.
But in my last memo, the calculus of value, yep, I did say that I think it's worth taking some chips off the table.
Yeah.
You know, to me, thinking tactically in the short term, the most important question is your portfolio. How much offense should it have and how much defense? And this is, maybe we can spend a minute on that subject, although we're running out of time.
Yeah, I think I only have time for one last question.
But anyway, you have to think about how much offense and defense your portfolio how much you should have normally, given your own situation, your wealth, your income, your needs, your desires, your dreams, your number of dependents, your intestinal fortitude, how close you are to retirement, et cetera, how secure your job is. You should set a normal risk posture for yourself. And then the question is, should you vary it? Are there times when you should increase the offense or increase the defense? What time is this? I think this is a decent time to have less offense than usual, even though I'm not yelling bubble.
Yep. I would have loved to go into more detail on that, but unfortunately, next time, hopefully next time, I can't end without mentioning the big news last week that was announced. Brookfield Asset Management is going to be acquiring the remaining 26% stake in Oaktree for approximately $3 billion, right, and taking full ownership. Yep. You've described your partnership with Brookfield so far as being a great success built on shared values of disciplined investing, long-term thinking, and integrity, right, and that becoming part of Brookfield in full is just simply a natural evolution for you. Could you explain to us the thinking behind this decision? Why was this the right time for full alignment? And how do you see this step shaping Oaktree's next chapter within Brookfield's broader strategies? Right.
Well, I'll try to shorten the story because I don't have too much time. But you know, there was a book, a very good book in the 60s called The Money Game, and then there was a sequel called Super Money. And the thrust of Super Money was that you make some money by starting something and doing a good job, but you make the big money by selling the company. And the truth is that if you start a company, eventually you have to sell it. You know, I mean, the Eskimos put a dead body on an iceberg and push it out to sea, but that's not good enough, in my opinion. You know, you should realize the fruits of your labor. Indeed. So, 07 was the year that alternative investment firms like ours became to be IPO-able, and as I recall, Fortress was the first company to go public in our space, and then Blackstone. We went semi-public. We sold an interest to institutions through Goldman Sachs. We didn't get the liquidity we were looking for. We went fully public in 2012. We still didn't get that much liquidity, and it's not that great to be a public company, in my opinion. So in 18, we were approached by Brookfield, which said they would like, at that time the company was half owned by the public and half owned by us. And they said, we'd like to buy out the public, and we'd like to buy a fifth of your half, So they started with 60% in the fall of 19. And then you can sell us the rest of your stock over time based on a formula, based on your profitability. But in the meantime, you can run the company. We thought that was great. We have a way to sell our interest at a full price at a time of our choosing, but in the meantime, we get to run the place. Great. And so we did it, and then we've had puts, the right to sell the stock over the years. I haven't sold much, but you know, by now, if everybody sold all the puts, they would now be at about 84, but yeah. But they're only at, 84, close to 90, but they're only at 74. But they came to us and they said, how about doing it now? And it's an inevitability, and we felt that it was a good time to do it. And we don't have to keep separate books. We don't have to preserve the concept of our own profits to get paid on. We just throw everything in together. And we're still running the place.
Indeed.
So, you know, that's what I'm in it for. I like helping to run Oaktree and helping to produce a great investment record and talk to people like you.
Thank you so much.
So
no, it's really been
just get on with it.
It's really been my pleasure and an incredible honor to have a conversation with you. My time is up, unfortunately, but everyone, now you have the chance to ask your own questions. My colleague has a microphone and he'll be passing it around. Who wants to ask? His hand went straight up.
Yeah. You can talk.
I think we can hear you. Yeah.
Yeah. Thank you so much for coming here today. You talked about how.
She wants the mic. The boss.
The microphone's a big problem, it seems, today.
Yeah. Thank you so much for coming here today. You talked about how success didn't teach you anything. So I want to know more about your failures. What was your biggest failure, and what did you learn from it? Thank you.
You know, we've handled the cycle timing about right. It's not our nature to make any investments so large that they can be big mistakes. We run a pretty diversified portfolio. We don't have any famous mistakes. But, you know, if you say what were our mistakes, I would say two. Number one, I was never optimistic enough. I was raised by very conservative parents. My parents were adults during the Depression, so they were scarred by the Depression. And if you grew up with parents who were children of the Depression, what did you learn? Don't put all your eggs in one basket, save for a rainy day, be conservative. And I bought into that. So I was never as optimistic as Buffett, for example. You know, Buffett always says, don't bet against the United States. I was not that optimistic. And of course, I was working in credit, which is not an optimistic area. And the other thing is, rightly or wrongly, you know, we ran the company to do a great job, not to make it as big and profitable as it could be. So other people did a better job of that, and other people who were my peers 30 years ago now have bigger companies. I'm not unhappy with that, because I think we did a great job, and I think we have a superior culture, and it's fun to work. It's fun for me to work under those circumstances, but you know, you look at my buddy Steve Schwartzman, his company's 5 times as big as ours. This one, right here. Oh, no, you need it. No, not allowed.
Thank you so much for the panel. It's a lot of insights. I just want to ask, kind of like, what's your view on digital assets, kind of like Bitcoin, crypto, how it's going to shape the financial world different?
If I make an investment in a stock, a bond, a company, a building, I do it for only one reason. I can figure out what it's worth, that we call that the intrinsic value, and I see if I can buy it for less. You can't tell me the intrinsic value of a digital asset. What is the intrinsic value of a Bitcoin? Where is it derived from? Now, you know, my son has been pro We moved in together during the pandemic. He bought it in March of 20 at 4,000. So I'm not in a position to tell him he's wrong, am I? But I still believe, and I say the same thing about gold, by the way. You can't say what is the fair price of an ounce of gold. Assets that produce cash flow, stocks, bonds, companies, buildings, you can talk about the fair price. An asset that doesn't produce cash flow, you can't talk about the fair price. What is the intrinsic value of a barrel of oil? You know, back in, what the hell was it? July of '05, I think, if I'm not mistaken, oil was $147 a barrel. And if you say to people, well, why is it at 147? They would say, well, the supply is finite. We are consuming it faster than it's being produced. And a lot of it's in the hands of our enemies. So its price will go up. 147. 6 months later, it was 35. All those things were still true. But an asset that doesn't produce cash flow doesn't have an intrinsic value. So you can bet on Bitcoin because it's a concept that you think is going to go further. And like I say, I can't tell my son he's wrong. And by the way, he says Bitcoin's been in existence 18 years. If it was a scam, you would think it would have come out by now. And there's something to that. But I limit myself to investing analytically, and I don't think you can invest analytically in Bitcoin or gold. So I don't do either one. Thank you. I'm going to try to shorten my answers.
Can I stand or? Okay. I mean, you talk a lot about like second level thinking and looking at what other people aren't looking at. And like, there's a million smart people in the finance world nowadays. Yeah. But what I was thinking about when you're talking about is, how do you separate the signal from the noise? Like, how do you know I'm not digging into a rabbit hole where, oh, the Mustang is probably the best car, but one is not going to be it? Like, how do I know that's a rabbit hole and going to actually lead to something?
You know, I've come to the conclusion in the last 6 to 12 months that the hard questions in my world are the ones that start with the word how. It's easy to tell you what you have to do. It's hard to tell you how. I can't tell you how. Some people get it better than others. And the great investors just get it. The great investors have a sense for, I wish I could come up with we put out a digital compendium of all the memos last week to mark the 35th anniversary. And they tell me it's searchable. I haven't figured out how yet. But in something I wrote, and I can't remember what it was, I talk about the fact that investment performance is like picking one ticket out of a bowl of lottery tickets. Some are winners, some are losers. You reach in, you pick one ticket out. You never know which one you're going to pick out. And that's why investing success is uncertain. But the way I put it, some people have a better sense than others for the ratio of winners to losers in the bowl. And they know when it's a good time to invest and when it's a bad time to invest. Other people who don't have that superior insight just play all the time and in the long run have average results. So I can't tell you how to know. But, if you want to try it, and after 5 or 10 years you'll know if you have the sense, because you'll see if you do better or not. The market, the one thing about the investment business, it gives you a scorecard, and after a few years you find out. Now, it might take 10 years to get for the sample to be an accurate sample, and to get away from individual events that are random events that nobody could have foreseen, but either make you a success or a failure. But after a while you figure out whether you really know what you're talking about or not.
I think the hardest how question is Howard Marks.
I love that.
Maybe in the front.
Okay.
Hey, first of all, again, thank you so much for being here. Given you've interacted with leaders in the finance world and the business world, what's like one common trait that we wouldn't expect that they all possess that you think it's important for us to adapt to?
I mean, I think they're all intelligent. That's the only thing. I mean, some of them are insightful. Some of them seem like blockheads. Some of them are have good EQs. Some of them are on the spectrum. Some of them are appropriately humble. Some of them think they have all the answers. There is no common thread other than intelligence.
Awesome, thank you.
Okay. We have one more. You have any specific picks?
You pick.
First of all, congratulations on the 35th anniversary of your memo. I really love your memo. My question is, I think no matter what the party in USA right now, there is a big movement trying to do reshoring every manufacturing factories on the overseas to this country. Do you believe the US reshoring movement will ultimately successful?
No. As short answer, no. But I mean, first of all, there's a guy named Neil Ferguson, Niall Ferguson, really smart guy, and he did a podcast on the tariffs back in April, and he said in there, I assume it's true, that every country, when it prospers and reaches the point of $30,000 per capita GDP, I guess in today's dollars, it loses manufacturing jobs to another country where people make less than 30,000 and they're willing to do manufacturing jobs cheaper. Who the hell's going to do these things here? You know, an iPhone costs, I don't know what, let's say $1,000, and people tell me that an iPhone made here would cost $2,500. So even if you could get them built here, I mean, the one way to get an iPhone built here, obviously, is if you put a $2,000 tariff on a foreign iPhone. It costs $1,000 plus the $2,000 tariff. Now it's $3,000. If you could make it here for $2,500, you could make it here and sell it for $2,500. Who's going to pay $2,500 for an iPhone? And if you make people pay $2,500 for an iPhone, then you're not going to sell a lot of iPhones, which means we're going to have a recession. So it's very hard. And the other thing is that President Trump announces a tariff, as he did on April 1st, 2nd, and then he pauses it on the 9th, and then he changes it on the 12th, and then he lowers it on the 18th and raises it on the 23rd. Who's going to build a factory? You're not going to spend billions of dollars to build a factory unless you think you know what the tariff's going to be by the time the factory is finished being constructed. And how would you possibly know? You know, I mean, I think that to make business decisions, people require predictability, but there's no predictability these days. And I think that President Trump, being a wheeler dealer, I think he thinks that the predictability is for suckers, and you get further in negotiations if you're unpredictable. And of course, he's very unpredictable, but I don't think that creates the conditions for people to build factories. So, as we say in sports betting, I'll take the under.
All right. I think we're out of time, but you guys, whoever didn't get their questions answered, you're in luck. You have 35 years worth of memos online for free. You can go home now and you can find the answer to whatever question you have.
Well, the truth is I've written it already.
Exactly. So you're in luck. Howard, on behalf of everyone here, thank you so much for your time and your wisdom. It was a true honor and a privilege to share the stage with you today. And I look forward to reading your next memo. Please, ladies and gentlemen, join me in thanking Howard Marks.